alive. You guys ready to get going? Yeah, welcome to Forex.Today, the YouTube community of let's just say almost up to 20,000 currency traders. That's a lot of currency traders, man. This is a small niche industry, yo. Small niche industry. Anyways, thank you for being here. Thank you for being a subscriber, being a positive contributor to this community. I think in many ways we make the world a better place through our collaboration and companionship. With that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I'll be your guide on this journey we call Forex. Please ask questions. Participation is the key. I will use my almost 20 years of experience. Sometimes I do something right. More often than not, I still do things wrong, but I learn from everything. And that's an accumulation of almost 20 years. There's got to be a few gems in there. So I will do my best to share. Technical analysis, fundamental analysis, macroeconomics, global money flow, finance. Well, anything that will help, actually. So let me know how it can help. I'd like to recommend TradersWay.com to you as a boutique foreign exchange trading firm that would like to earn your loyalty and respect like they earned mine. You do that by visiting TradersWay.com, opening up a demo account, and placing some trades. You'll say, hey, nice execution speed. Wow, look at these swaps. Nice. Hey, spreads aren't bad either. Yeah, I traded euro dollar the other day, and I tried to calculate it, and it was, because of the spread moves, but I think it was like 0.4 pips. That's not on an ECN either. So anyways, competitive spreads, right? It's all good, man. But ultimately, you want a broker you trust, and they earned my trust a long time ago through their business ethics, if you will. So TradersWay.com. David wants to know, do I use a binary entry trigger once I've done all the analysis? Right? Well, usually it's price and price action, David. Not necessarily just not like, there's two ways. I could say sell at this pivot point or sell when there's a reversal pattern at that pivot point. Okay. All right, so let's go through the world. Russia. I know you know. So let's just take a look at what's going on. Okay. Now this is WTI, my oh my WTI. I've split the hairs here. These are days. Okay. Yesterday was an update, and now today is was up, was down, sort of like now right back to where we started. Remember, yesterday, the United States of America was closed, so we have more people returning to the market. Now, this isn't very informative, so we can add some more information here and see how that helps. And you're like, oh my gosh. Okay, now you know why I use pivot points. Okay, that's the conservative projected high for the month of February. Okay, without that knowledge, it would have seemed that 9620 was a random number. It wasn't a random number. Okay, doesn't mean it's over. Someone can still buy this from the bottom and take it. And then this is the ultimate top where you have the aggressive target. Okay. Both weekly and monthly. 99 isn't important. The other thing going on here, of course, why did that top out there? If you look at Brenty, do I have Brenty here? I do have Brenty. Okay. Our buddy Brent here went to 98.8 and a little bit above, 99 and some change. And remember, the ultimate top here psychologically is 100. Okay. But nonetheless, this M2 swing took us to an M4 target. And that, based on swing trading, is what's supposed to happen. Okay. Now, one of the things we've been talking about in the group is that, you know, a swing trade pattern like this is a trend trade, but we were not in a trend. Well, I mean, the trend was sideways, right? And that would be an uptrend trade, which didn't actually exist. So you had to trade it more like if you were a bull, you buy at bottoms. Okay. And you can buy, jam your stop, and if it comes around again, okay, you're still in maybe. Or if it makes a lower low, you're out. But it could go up to where? Well, it could go up to, let's do it this way. You can go up to this target and then collapse. But that's enough maybe to jam your stop. It might go to this target, but since you're a bull anyways, it might break out to the upside, and you'll say, well, because of geopolitical risks and it's such a big psychological target, you know, everyone wants to go for that. But the thing is, you never know. You don't know. I don't proclaim in these situations that I know this is going to go up. So we always break it down. Well, what's your fundamental belief? What's your fundamental bias? You've done the research. You know the market situation. Do you think Russia's going to attack, or do you think people think? That's even more important, right? Do you think that people think Russia's going to attack? If so, you're going to be more bullish than bearish. Anyway, so if you made the trade, then good for you. And if you didn't, I understand why you didn't. Okay. Also, one of the things we worked on in the swing trading group, and this goes back to Sunday night. Yeah, we met even though the market was closed, but nonetheless, one of the things we focused on is going back to bigger time frames and starting your analysis there and continuing your target. So looking at the daily, right? This is the general target for the month of February. It just is. I mean, there's no other way of saying it. Okay. Now, you might say that it's an amazing number to be where we are. Let me get rid of this. But, okay, in a situation like you see, we call this open, okay? It's an out of position open. Okay, so if you were going to use, let's say, the ebb and flow of price action and pivot points together, you would say there was a pretty reasonable potential for something like this before it went up. Let me get rid of that. Okay. That would be a pretty reasonable, pretty normal pattern. But instead, it went from bullish to overbought, overbought. And typically you do hit this target area, but you hit it fairly early in the month. Like within the first week, not the 20th, but like the 5th or something, right? The 5th, the 10th, the 12th. So if anything, this could have happened actually quite a bit sooner, and it didn't. So it tells me that the market isn't out of control. It's behaving fairly logically. Okay. And under normal circumstances, we are essentially at the end of this move, and that there should be a normal pullback. Okay. Maybe as far as here. So let's say back to 90. And then bring some new bulls into the market and go from 90 to 100, maybe even above, right? Now, if this final move is based on a anticipated supply shock, so this is demand, this is supply, one, and this is quantity, and this is price, okay? If you believe, because, Europe gets 30 or 40% of its energy from Russia, and we're looking at Brent here, which is international energy, if they believe that Russia invading the Ukraine will diminish supply, then you'll notice that we went from equilibrium price 1 and equilibrium quantity, okay, P star and Q star, with the diminished supply, so now quantity falls to Q2, and you'll see that price 2 is higher. So so if you believe this last move has to do with the threat to supply, then your standard pattern of something more like that is less likely, because it's not a technical play. And it's not a normal supply and demand. We're not looking at the supply and demand today. That move would be based on, oh my God, Russia's going to attack the Ukraine. In 3 months, we're going to have less energy, less oil, and therefore prices are going to go higher. And so now people are using this as a hedge, for example. Well, then that's not necessarily current supply and demand fundamentals. It's potential supply and demand fundamentals. So now maybe Russia, we should say Putin, right? If Putin says, look, I got the territory I wanted, we're not going to attack, but I help these separatists, so they gain a little bit of land, and he can save face and go home and say, well, I didn't back down, I got what I wanted. But, right, then cool. And then all of a sudden people are like, oh my God, we're not going to have a shortage of oil. We will have less of a shortage than we thought. And then we get our little pullback and then go back to there. Okay. Okay. Unorthodox says if you go back 20 years, these things never escalate into war. That is true. In the last 20 years, that is true. It has not. But throughout history, it does, or it can, and it never does until it does. Okay? It never leads to war except in the situations where it does. So, right? That's right. Your customer also brings up Nord. Yeah. So they pulled the plug on that. All right. So anyways, what I'm offering to you is that these are important moves. Okay, these are important moves, but the market is not freaking out. So if you sit and listen to the news all night and you're hearing it getting worse and worse and worse, this guy said this and that guy said that, and this is going to happen and that's going to happen. Did you hear right? Okay. Then you can get amped up. I want you to look to the market for clues as well. And they're trading the same concerns, but this market is not freaking out. Okay? There may be some undue volatility. Okay? Because we're dealing with the Fed and geopolitical risk, which really makes things complicated. But at the end of the day, within, let's say inside an intraday range, right? There's a lot of volatility, but maybe on sort of the monthly position type swings, it's not that crazy. Okay. And so we all need to make adjustments perhaps, right? Looking at crypto, Let me move Brent to Ethereum and move Ethereum down to Brent. Right? So now we got WTI, Nat Gas, and Brent. Take a look. Okay, cryptos have been down. Okay. Ethereum's not too bad, but I'll tell you, see this dotted line? That is the best selling pivot of the month. So if you were looking at how prices behave since then, so I'm kind of looking at this now, what you would be anticipating is lower low, okay, lower high, lower low, drag this across, lower high, lower low, okay? And that the general strategy, so that would be a tactical point of view, but strategically, this says your target is down here. So now you have to kind of go up, down. Will this be a problem? Hell yeah. Look at it. That's potential support. But if you are truly a bear, you believe will break support. So that'll just lead to something like this. And then we'll finish February down at 1535. What? Dude, that sounds cheap, doesn't it? Huh? Morning, Meta. That's crazy. That sounds crazy cheap, doesn't it? I don't know. I mean, what can I say? That's what it says. Wow, huh? Let's do a poll. Let's do a drop. Or let's do a poll, I should say. Good morning, everybody. Good to see you. Ba 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 ba. So anyways, going back to Unorthodox's comment, over the last 20 years, which is interesting because it's not really enough of a sample size, right? If you were, what's the guy's name? Bridgewater guy. He went back 500 years. Okay. And he would tell you it always leads to war, but you're both correct. Of course, right? The scale of the time matters. So over the last 20 years, have major superpowers entered into any major one-on-one battle? No. That's right, Ray. Okay, no. But if you look at historic norms, he would say, well, it will always lead to war. It's inevitable, but it probably is 50 years from now where the United States and China go to war. Okay. But thank goodness we killed communism. And you're like, well, the Chinese are still communists. Yeah, but things are a lot different now than 30 years ago. Let's just put it that way. All right, let's take a look at you guys. And everybody says down. Bring it down. Bring it down. Now, here's my hunch. Remember, I'm not talking about technical analysis anymore. My hunch is that it'll take all of March to get us down there. Okay. Okay. So like maybe we get to the double bottom by the end of February, which is not that far away, I suppose, right? And then we have some up in March, and then we're down to that price level, okay, at the end of March, and then we start buying it up. Mike, just Google it. Fed meeting March. I think it's the 17th. Okay. So I'm still risk off mode until approximately April. Jim, I think that's the first day though, isn't it? The announcement I think is the 17th. Isn't the 17th Wednesday? I don't know. I'm going from memory. I don't actually know. Because remember, it's a 2-day meeting. Guess we might as well look at some nat gas, huh? Why not, huh? I'm not sure if this is updating anymore. I'm pretty sure this was taken off the platform. 1607. Yeah, it's not even updating anymore, huh? Oh, yeah, no, it's updating. Sorry, Jim. I was certain now, but now I was certain. I get it. Sorry about that. That's not European prices, though. No, it is not. Taking a look at how exotics are doing. And this is kind of interesting because as commodity prices go up, despite the geopolitical risk and potential for dollar strength, these ones are producing actually fairly okay. They're maintaining bullishness in markets that are not necessarily bullish. Okay? So you can see now with this peso, we're at the moment of truth. Okay? So this wonderful 382 entry, look at this. It's just amazing, isn't it? Isn't that amazing? Come on, dude, seriously. Look at that. Okay? Then you get the lower low, lower high. Okay, lower low. This one's freaky. Sorry, but anyways, it still ends up being a lower high. Okay, lower low, lower high, and then here's the thing. You might say, well, this is pretty easy. Now there's a lower low again. Well, this is a real challenge. So could it now do something like this? Yeah, for sure. Oh, for sure, eh? Yeah, so now it gets interesting. So here we are in the moment of it's either going to go up or it's going to go down. And to hit this 55 and then start dropping, boy, that feels potentially good for a lower low, huh? Up until then, it was probably not, but it just might stick. Cool. Okay. Okay. And remember the interest payments on $1,000 of margin. I think that's approximate. I have to double check. I might be way off. It might be 2,000. But anyways, let's say with euro dollar to get a standard lot, you'd have to have right? Anyways. So you're earning $5 a day. PD. Okay. On $100 of your cash, not 1,000, sorry. Okay. You earn 50 cents a day. $0.5. Okay. Okay. Is that a lot of money? You're like, it's only $5 a day. Well, what's 5 times 365? Well, you can't calculate that. What's 5 times 400? 2,000. So we know it's less than 2,000, but more than 1,500. So let's say it's $1,682. Okay. In interest payments based on your $1,000 investment. All of a sudden you're like, hey, you know what? That's pretty reasonable. You know, like, oh my God, right? Oh my God, that's pretty good. Because remember, when you cash out of your trade, you get your $1,000 back. So just in interest, right? You earned $1,682 on top, based on your $1,000, plus all the pips you've made. And of course, you know, you'll make much more money on the pips. But even if you made no money on the pips, that's a nice little investment. So you really want this to make a lower low. Okay? And you might be here until July or January. You get it? It's pretty cool, right? That used to be the whole sort of reason for trading Forex. Okay, so that's nice anyways. That's pretty nice. South African Rand, even better. And then Euro Rand, even better than again. But then what if Europe moves interest rates all the way up to 0? Which is funny, right? Up to 0. But nonetheless, so going back a bit, this is USD Rand, South African Rand. It's an emerging market play. It's a high yield play. It's a commodities play. Okay, so it's a level of complexity a little bit more than Mexico. On says, why not hold it more than a year? Well, you totally could. Okay, absolutely. Okay. But with the normal ebb and flow on, you can have like, let's say this is January and this is January, right? Your year could kind of look like this, and then it could look like this, and then it could look like this, and then it could look like this again. Let's say a little higher at the end. So you bought it somewhere, let's say you bought it somewhere in here. So let's say here or here. And you would have to go through August, September, or whatever, July, August, September, and then hold all the way. So the thing is, the challenge to carry trading is, you know, if you hold it from January to January, you'll make 150%, let's say. Okay? Internal rate of return. Just on the interest. So you want to hold it as possible, but 95% of your profit's going to be based on pips. So if you got out here, let's say you would have a 1,000% internal rate of return, plus, you know, let's say this is only, you know, let's say that's half, plus your 75% on the interest. But you decide, well, you want to go for the 150% interest internal rate of return by holding it a whole year, but now you risk giving all of this back and then have it recover versus just take your money here, play out the seasonality and buy it back there. Okay? And you break this into two pieces. So, right? Okay? So you'll always get into a psychological issue with carry trades where the pips are so much more significant that you at some point will take the pips and run. And if we haven't had carry trades for so long, almost 10 years, that most people here have never had a carry trade. But I used to coach people through carry trades all the time. And we used to cheer every time you got your first 1,000 pip trade. And I'm not talking about no stupid micro pips. Okay? Okay? Where you buy euro dollar at 120 and now it's 130. Yeah. Not micro pips. Newer traders get that mixed up. Maybe it's gurus are talking about it that way, but that's dumb. So 1,000 pip moves used to be, something that you would celebrate. Now that takes a couple of months, maybe even a whole year to be in that trade, but that's how it used to be anyways. But what you'll find when you start to be in trades that long, first of all, you need a trend, and our trends have been crushed with first Omicron, and now we get geopolitical risk. But even seasonally, we don't typically have trends this time of year. But nonetheless, what you'll find is once you learn how to carry trade and you're in your trades, a month, or let's say you're in the trades for 5 or 6 weeks and you're about to face the inevitable pullback, that's when you lose sleep at night. So if you expect this to happen and you're here at that X, you're really, really, really going to want to take profit. But then you're like, but I wanted this to be a carry trade. I wanted it to be in it for a whole year and collect that yield. But then the other side on the right, that's the angel on one shoulder. The devil on the other shoulder is like, take the money and run. Don't be stupid. Take the money and run. Take the money and run, right? And oh my gosh, it's very, very, very psychologically challenging. Okay? And that's why not, realistically. But if you could just close your eyes. Wait, that's an Ozzy Osbourne song, isn't it? If you close your eyes forever, could I learn how to carry trade? Right? Yeah, the pips give you more. But I mean, look, it's a delicate balance. It depends on the year, the market conditions, where you are in the business cycle. There's a lot that can go into it. Some years it may actually be, some years, let's say 1 out of 4 years, right? Well, let's say 25% of the time, the right answer may actually be to keep me hanging on. I don't know why I'm getting all these songs. Hanging on might actually be the better answer. So like a couple of years ago, we had a situation where we had quantitative easing. And so if a year looked like this, if this was a seasonal, right, again, January, if this is Jan to December, and this is what a year looked like in a normal year, so I'd call that seasonality, with quantitative easing in the picture, we've seen that the market can do this. Why doesn't it pull back as much? Well, all this BS money. Okay? So in that circumstance, maybe hang on. By the way, speaking about BS money, I got someone sent me a terse email calling me out, you said, about me receiving free money from the government, the stimulus money. And he says, I should give it back in his terse email. And I just want everybody to know, like, no, I didn't file a request to the government. Please give me free money. It just showed up in my bank account. Okay, why? I don't know. I honestly don't know why. And I did give it back. I did. I went to restaurants and bars and hotels almost immediately after. I spent it on hotels, restaurants, and bars, and I tipped 30% or more on my bills. And I personally thanked the waiters. In some cases, there were no waiters, but I personally thanked the bartenders. I personally thanked the chefs. I thanked the people at the front desk. Okay? I thanked everybody. And I gave all that money back. So I did. So just want to get that off my chest so I can sleep at night. Okay? Gave it all back. But even more. Cool. Let's go over here. We got to do the dollars first, right? Okay. So what's going on here? Well, it depends on what happens next. Okay. You can see the general state of affairs here is up and down and up and down. And that would be normal. Typically, if you were in a risk-off mode, dollar would get strong and euro dollar would fall. That'd be the general operating procedure. Now, perhaps because we're talking about a threat to European economic conditions with the Russians invading, because then there could be a supply shock and prices go high and it hurts economic growth in Europe. In that case, the game theory of this is Europeans bring money home. It's almost like in Japan, if there's an earthquake and a tsunami, and a city or several cities in Japan are seriously damaged. So it's not just the earthquake. Okay, it's not just a tsunami, but if there's serious damage, okay, that's not geopolitical risk now. This is natural disaster. But the instant response you're generally going to see is people in Japan are going to need cash. So money comes home. Demand for money from Japan goes up. Think of it that way. The demand for money. So when you do economics, you can actually have money demand. And I always think it's an interesting chart. But anyways, quantity and price again. And now you have demand and you have supply, and demand goes up from Q1 to Q2. Okay? Wait, did I do that? No. I moved supply. I'm like, that didn't work out. What the hell, Wayne? Come on, I moved supply. Okay, there you go. Demand goes up from Q1 to Q2. Okay, the price goes up. Now, why does demand go up for money in a time of a natural disaster? Well, you might be out of work for a while. You might need money, right? Think of it, people taking it out of investments. And they're like, you were putting money aside for a rainy day, investing into Australian bonds or something, but suddenly your house has $30,000 worth of damage. And that's not your normal, that's not a normal part of your cash flow. So what you do is you take money out of your savings, which in Japan is not in Japan. It's outside of Japan because they have zero interest rates. So your money might be in New Zealand, your money might be in Australia, your money might be in Canadian bonds or something, right? So all of a sudden there's this demand for cash, and those assets get sold off and get converted into yen. So demand for yen goes up, and all of a sudden you get Japanese yen strength in a time when their economy is under threat. Now, reverse this situation and think about maybe the European situation. It's not a natural disaster. It's a geopolitical threat to the supply of energy and to economic conditions. And so money invested out by Europeans outside of Europe might need to come back, right? They may need to exit that and go to cash. Okay? Because they might need money for a rainy day, so to speak. And Alex is like, and then suddenly it's raining, right? So anyways, that could be interesting if this is because it's Europe, we kind of get a different scenario. Okay, you get a different scenario than the standard playbook, because usually you don't have that kind of geopolitical risk in a Western country, right? Like, oh my God, Belgium is invading France, right? Yeah, you're like, yeah. So this is an interesting situation where normally you'd see euro dollar fall, but all of a sudden you're seeing euro dollar go up, which is kind of interesting, right? They sell stocks, still sell U.S. stocks and convert to euro. Yeah, that would be an example of that for sure. Okay. Or where else would Europe have money parked? Think about it. Dig deep. Where else would Europeans have money parked if it was parked outside of Europe? Well, that would, right? Mike says Switzerland, but the thing is, guys, that would be typical of sort of a risk off. Like they wouldn't be doing that. See, you would invest outside of Europe in a risk on mode. Okay. No, I'm asking where, not what, guys. Thank you. Demo traders got it. The UK. Like, where is it parked? Even if you parked it in commodities, but where's your account? Okay. So anyways, so in here we see the pound weakening and the euro rallying. So this is pound falling and euro, okay, rallying over that same period. Is it plausible Europeans had money parked in London and now they're bringing it home? The answer, of course, is yeah. Yeah. And it looks like this. If you want to see it a little nicer. Money is leaving here, okay? Money is leaving here and going here. Perhaps. Okay? Now, on in Milo say emerging markets or South Africa and Asia, that wouldn't be the first choice. Okay, that's a much smaller piece of the pie. Okay, that's a much smaller, that's a very, very risky now investment, and not, we're talking about most people, most households, large percentage of the aggregate that we're analyzing. Money going from, Germany to South Africa as a percentage of money leaving would be quite small. Most of it would go to China, the United States, so on and so forth, right? Okay. Your customer says Russians could be moving money. Yeah, for sure. Okay, right? It's the same sort of cause and effect, right? Yeah, good point, Darko. Okay, so anyways, it's interesting. Okay. This going up is risk off. These coming down are risk on. Okay, this is risk on. So we'll see if there's sort of a recovery in these moves. Okay. Also remind yourself there isn't one answer. These are fairly complicated issues, and people around the world, you know, like how many people around the world are not concerned about their money? Like none, right? So there's money sitting and parked in places for various reasons. There's money invested for various reasons and in various regions. And money can move, like geopolitically. Money can move based on natural disasters, but money typically moves based on business demand, economic reasons. And so part of this play that we're trying to focus on, like this play here, if you remember over the last couple of months, we've been talking about the China recovery play. And that's kind of going on now. But then we got this geopolitical stuff going on closer to home. So I'd almost separate these. Okay. Like Russia invades the Ukraine. How does that affect New Zealand, demand for New Zealand dairy products? And you're like, well, probably none. Well, there you go. So there's your safe haven. Right? If I close my eyes forever, could I make my carry trades? That butter price is up 5%. Oy vey. Okay. Look at prices here, huh? Holy smokes, eh? We're getting really, really close to the high, man. Like, look at that. That's crazy, huh? Okay. Now you're like, well, Wayne, what are we looking at? Why are we looking at this? Hang on. Let me adjust. Let's see if we can do this. Work with me, dude. Work with me. That's too far back. 16, 12. Okay, 12. Okay, so it shows some potential here. Let's start with, okay, let's start with this. So back in 12, okay, we had a drop and then a very, very, very significant rise. Okay, we had a drop and a very, very significant rise. Okay, this is the value of the New Zealand dollar, and this is the value of dairy products. These are auction prices in dairy. Okay. Okay. And then we have stabilization in dairy products and then a big drop. Notice that the currency fell first. Okay. 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 Farted around to about the 15th. So we're right here. Okay. Now we're here. Okay. Let me try to line this up. Okay. Here to here is in the middle of the 15th, early part of the 16th, which is about here. So this drop from here to here lines up with this. Then there was an up, a down, and an up. An up, a down, and an up. Now more dramatic in currencies. Notice the currency is more dramatic. Okay, there's probably a steadier demand for food but currency prices can fluctuate more, but you can see there's a bit of a relationship going on. Okay, stabilization, but generally down for years. So now I have to move the chart here. Okay. Okay, steady down for years. And then around April 20th, we bottom. Let me click in here. Around April the 20th. Okay, that's February. And what I'm trying to look at here is, see if I can adjust. Around here, okay, this area, May 2020. Okay. So around that price, around that price, which is sort of in here, there's a steady recovery. And up, 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 and up. Now, with this Omicron more recently, it pulled the economy down because they had to shut the economy down. But that actually has pushed up prices, which eventually, right, with a full functioning New Zealand economy should recover and benefit from these higher prices on the short run. And what that kind of is showing you, let me go back one more time and try to make a point here. If, for example, now you might not believe this, you might disagree with me, which is fine because I don't know. Okay. But if we see, okay, that these prices are about the same, could it be possible that demand for the currency to buy these products increase so that the value goes back to 2013 prices? Is that reasonable to think? You're like, well, last time we were at $1,600, right? We were at, let me back this out now, if I may. Okay. Go back to 13. Okay, we were here. That was the value of the currency. Could we plausibly work our way back to that price? And that's not even on the chart right now. Another way of saying it is, based on what New Zealand does for a living, the New Zealand dollar could be undervalued because they export. A large percentage of their exports are these dairy products, and they have a high impact on their GDP. So again, if we were trying to compare these things based on the last time prices for dairy products were at 1,600, the currency wasn't priced here, the currency was priced up here. So this is a gap now, and this could be your alpha. With People's Bank of China easing. The Chinese economy recovers, the stock market recovers, Aussie, Kiwi goes up. Yeah, but it's not because of the stock market per se. It's demand. You have to look at an increase in demand. Okay, so you see how the logic here that the Kiwi could be undervalued? And so you'll see tonight the RBNZ raises rates. Okay? If not now, well, soon. Okay? Okay, so we have a valuation gap here. So if we were to look at, I don't know, I guess we'll just pick Kiwi dollar. Okay, so here's that mid 2013 price. Okay, so could the New Zealand dollar be on the way to a 1618? Any thoughts? Is that right, Kevin? Very cool. That's good news. Yeah. Victor says not without a struggle. Well, for sure. And it doesn't have to be dollar. I was just pulling up. I was trying to compare apples with apples, right? Right. But maybe it's Kiwi Swissy. Maybe it's Kiwi Yen. But remember, the next 4 months, I think the dollar will go from strong to weak, and then the yen will go from weak to strong, right? Okay. Okay. If you see here, this is the best price a bull would buy. This is the best price a bear would sell. And one of these teams is going to win. Which one? Don't know. So one of the things we talked about on Sunday night in the swing trading group is going back and reaffirming these ideas, these really the strategies, and not get caught up in sort of the day trades only. Okay? That's the hardest part about day trading, is the more you day trade or intraday trade, the more you get sucked into only looking at the, let's say only price action. And then you miss the bigger picture, right? Where this could have just been a buy, this could have just been a sell, and the rest you just kind of walk away. And then from that, you set up your weekly swings. Okay? So like we change this, let's say, and we just do confluence. What does it tell you? Well, if you were a bull, okay, let's do this. If you're a bull, your trade plan for the month is that. And this is the best price you could hope for. Okay, cool. The next stage is, where do you buy as a bull on a weekly basis? Okay, this zone, and this zone. So you have this trade, you have this trade, you have this trade, and then this one you didn't get. Maybe you caught that little pullback, but probably not. Okay. Cool. Well, now you know you're being threatened here, right? Okay. But that, right, you can see that these traders see that as a potential entry, so they would have had that part of their plan. On says, seems like people are front running the RBNZ rate. Yeah, well, that's what people do. Okay. Here's the other thing. Everybody that's gone through FX Bootcamp has heard me talk about seasonality over and 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 over again. Seasonality tells me that in January you do this, and in February you do this. Okay? And that's that. So maybe it's people fronting the RBNZ, front running the RBNZ, or maybe it's just seasonality. Okay? So like an example of that is Aussie dollar instead of Kiwi dollar. Okay? And I have to keep clicking back out. Okay, you see this? There's my entry. Long. Okay, so remember what we talked about is seasonally, this is what usually happens with Aussie dollar. And then seasonally, this is what usually happens with Aussie dollar in the next month. And then what will probably happen, I don't know when it'll start, but I do expect this to happen. And right, so you could say, well, Kiwi dollar doing something very similar. You could say, well, that's people front running the RBNZ. I couldn't tell you you're wrong because I don't know what people are thinking. But I know the RBNZ isn't always raising interest rates in February. But I can tell you over 20, 30, 40 years, right, I have some seasonal biases. And what gave me the strength to buy it the first minute of February? Knowing 20, 30, 40 years of price action history in this case, right? What we call seasonality. So it's a framework, like a lens, if you will. Okay? Okay. Now, what I don't know is, so my next assumption is this will head back down. Okay. Not all year, but it will head back down, sort of the ebb and flow. What I don't know is when does it start that? And in many of my trades that I made in that minute, just, days later, we were at interesting levels in which I did take profit for I think one trade was 300 and the other one was 250 in just a couple of days. That's a big move in this market. This one I just left because, again, it's an example. This trading account is sort of like examples for you, right? And that in the first minute of February, I bought this to be an indication of seasonality for you. And here it is. What are we on, the 22nd today? Okay. We're still in the trade. Is it the right thing to have held on through this? Well, that's not necessarily what I'm saying. I want you to go through and think about what you could do or should do. It's an example of what could be done, not necessarily that it's right. I don't think there's right and wrong in Forex. Okay? You make decisions and determine strategies from your decision-making process. So if this happens to break out, well, then this looks like a good trade. But nonetheless, if it doesn't, then it's a bad trade. And no, you just made decisions, and there's consequences to the decisions. And there's so many variables that we don't know that I wouldn't beat yourself up if it doesn't always work your way. The thing is, you saw risk, and then you thought about what would happen, and then you made a decision. So like right now, this trade has 160 pips locked in profit. I'll move it down to 150. There you go. One, right? See how it says 1,500 pips? See, those are micros. No. That's only 150 pips, son. Okay. So anyway, so that's all locked in. That's my worst case scenario. Okay. And if it breaks out, comes back, and then moves, then I'm going to move my stop to here. Lock in maybe 200. Okay. See that logic? And if this was textbook, now I don't think we're in a textbook market, but if this was textbook, we would be heading here. Oh my gosh, that's where my limit order is. Dude, I set that on February 1. Okay. In the first minute of trading. Bought it here, set my limit, done for the month. It's possible. Okay. It may not be the right decision, but I want to show you that it is possible. Okay. Because some of you guys might have jobs, careers, and kids, right? Careers and kids. So you're like, Wayne, I want to trade, but I only have, I can only trade once or twice a week. Well, here's a monthly trade. Here's a weekly trade. Okay. Here's a weekly trade. Here's a weekly trade. Okay. And grandkids, yeah. But the thing is, if you can only trade once a week, you need to be a swing trader. What's common about every single one of these trades? You made the decision, drop the lots on a Sunday or even a Friday. Okay? So if you're at your let's say you live in New York City, you're right, Fridays at 4 p.m. or let's say even 3 p.m. Let's say Fridays at 3 p.m., you spend an hour at your chart. Okay? And then maybe Sundays at, we'll say 6 p.m. Those are the 2 hours a week you spend on Forex. Then you would be a swing trader. And you should learn how to position trade too. So you're not just, right? Like, for example, here's a typical swing trade. That's either Friday or Sunday you make the decision. And, okay, that actually gives you a target between here and here. It's unfortunate that we just missed that target, but you get that. Cool. Okay. Then again, Friday or Sunday, you make a decision. Maybe the market opens here. Maybe you buy that, or maybe you drop the limit down here. Both are correct. And your target is up here now. Okay? If you were a swing trader only, what you do is you buy, you exit. That's why those X's are potentially there. Okay? You buy, you exit. You buy, you exit probably, right? These will probably line up. A position trade is very similar, except you buy and you hold for weeks, not 1 week. Okay? What you'll see in a lot of swing trading is you buy on Sunday/Monday and you're out on Thursday. You buy on Monday, you're supposed to be out on Thursday. You buy on Monday, maybe by Thursday we're up here. Okay? That's what swing trading is. That's why we meet on Thursdays, because we're creating new plans. See, we meet on Thursdays for swing trading because we're making new plans for Monday. Okay? Which could be a Friday front run. But the interesting thing is we meet on Thursdays so that Friday and Monday you enter your trades and now you're done for the entire week. Okay? And if you're set at, how do you want to do it? A 99, 333. Okay? If we're lacking, if we have more volatility but less trend, okay, 99, 222. Right, entry. Yeah, see, these are only 150 pip moves. Pretty small. Okay. Yeah, 150 pips, right? So these are, again, they're small, 75, 150. Now you're only doing 2 to 1. Okay. So maybe having some of these, okay, like this one you plan, and you're like, this one I need 333 on this one. Okay. These ones, right, you do 75, 150. That takes you out. No, you're out for a day or two. Okay, you throw down a limit with 75, 150. So where is this? 71. So we got to get to 72.50, which puts your limit about here. Okay. And then you let it fart around, so you're still in that trade. So maybe you try another one or you leave that one. So again, 75. Maybe you have one here. And now you're at 71.50, so you got to get it to 73. So you're right. These are your targets. So what you're planning on weekly is in, out, in, out, plus this bigger one. Position and swing trading. Yeah, that's right. Chulwe says, hey, so you mean you only analyze on Thursday, set your buy and sell limits, allowed to enter the trades on Friday and Monday, and then exit again on Thursday? Yeah, that'd be very typical. If you join the swing trading group for $99 a month, yeah, that's what we do. Are there seasons that are favorable for swing trading? Yeah, absolutely. You can expect different things at different times of the year. So what I just explained to you now is probably what will work well in Q1, but will not be the optimal strategy in Q2. Okay? The direction to this will probably change in Q3 and then change, right? And so the reverse optimal strategy would be this, but reversed. But in Q4, we'll probably repeat Q2 So stuff like that, like, yeah, it matters. So it's not like, oh, what I just taught you will make you be a millionaire. No, hard work over long periods of time will make you a millionaire. All right, I want to run an ad right now. I want YouTube to benefit from this stream, and I'm hoping they'll promote the stream if we run an ad from time to time. So please forgive me. You'll probably get some sort of advertisement. I don't know if it's just a little pop-up banner or running a 30-second not skippable or whatever. But that's for YouTube. Let me know, what kind of ad did you get? Was it a like skippable video ad, or was it just a little banner pop-up? Please forgive me. I know not what I do. Really? I clicked a button that says throw an ad in. Jim R got one. Yeah. Victor's premium. That makes sense, right, Victor? VJN, VIP. Nothing yet. A 5-second banner. Look at you guys all premium and stuff. Heck yeah. Victor's great. He's like, here's Victor's MO. Hey, do you have any bigger yachts? Hey, this yacht's nice, but you got anything bigger? Yeah. But that helicopter's too small. Yeah. So some of you guys didn't get ads, huh? All right. Well, I'll tell you, it looks like about 30 people bailed. Okay, so 30 people couldn't take it. All right. Well, that's that. No loyalty. All right. Cool. Look at that. Oy vey, huh? All right. So, how do you put this one together? Swing trade. Yes, it's a top here. Swing trade. Now, I hate when it gets this. This is, again, sort of a reverse Arctic turtle, if you will. The big target's here, the little target's there, but whatever. The fact that it dropped off M3 down toward, well, it's at S1 now, but the actual target that setup would give you would be M1. That isn't predictable because that's a bearish trend trade in something that has been trending bullishly for a while. Okay? Oh, hey, Lucas, you got the email? I figured out what the issue was, got everything taken care of, sent the money your way. Everything is good in the hood. Okay. So this is a bearish trend trade in something that's been bullish. So I'm not trying to say, oh, look, you should have done that. All right. Awesome, Lucas. Yeah, I don't want to let you down. You can clearly kick my ass. So, right. I know we're going to meet sometime. Right? And you got to be my friend, not my foe. Right? Rule number 1. If if he can kick your ass, make sure he's your friend. All right, good. I put that down, right? Yeah. All right, cool. So let's go back to what we is know. What we is know, okay, is this is the predictable part. So it's sort of like this is kind of gravy, if you will. It doesn't actually help, except for maybe a target. Now, the problem with this is we might be reading into it because, you know, confirmation bias says, oh my God, in Wayne's book it says sell M3, take profit at M1. Well, is that what's happening, or is it just simply a top? Okay. Okay. So I don't know what to read into that. Okay. Basic assumptions here, though. Bulls buy at this price. Okay. The second one's better because it's sort of the inverse head and shoulders idea. This is the price bears sell. And you'll see why I said, like, this kind of sucks. And this is nice, but I would have rather have the other one hold. But notice, like, this one wasn't perfect, and therefore this wasn't perfect. And where are we now? We're more and more in the neutral zone. So, right? Okay. So be careful in here because I think it's easy to say, well, this is dropped, so therefore this will happen. Yeah, maybe. Maybe. But the problem is, once again, that's a trend trade in something that clearly is bottomed where bulls would buy, topped where bears would sell. So what's happening here in the middle? Pigs are being slaughtered. Because remember, you're either a bull, a bear, or a pig. Okay? So looking at sort of a position scenario, if you were bullish on this because of this move here, let's say, and then the month opened here, okay, you either bought it instantly or you threw down a limit order and put a stop here. You're like, well, Wayne, how do you know to do that? Well, that's what's in my book. That's what's in my training courses. That's how you make that trade. That's just it. I mean, I don't know. That's just how you do it. Okay. Now, if you're a bear, okay, you would have waited for something quite, well, exactly the opposite. So you're like, well, we're down here. Can't really, right? I don't want to sell it low. I mean, you can. You could try selling here. You can. And then in this case, it didn't work out, which is okay. You probably broke even. Okay. So you let it rise and then you tried selling it. Okay. That would have led to a break even. And that's an honorable trade. It didn't make money, but it's honorable. You didn't do anything stupid. Okay? Because, you know, a bear is either going to sell this or a bear is going to sell that. There's only two choices on this time frame. So if it dropped for a week and then rallied for a week and then you sold it, and then it pop, 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 pop. Okay? Okay. You took a loss. You took a break even. Even if a loss is fine. The thing is, your plan B is sell it here and your stop is here. And now that you got this lower low, you probably jammed your stop in your hero and zero again. Okay? That's the bearish point of view. So if you've done that, that's great. Now, I'll tell you why, like, you got to be careful in here. Only sort of, I would say, a profitable bull could plausibly buy this. Okay? So someone may have bought it here or here. And they might have actually even bought this. So this is their trade so far. and they're happy with this result. It's pulled back, and maybe they had an order here, and they're connecting these dots. Now, that's a little bit challenging because you never got the higher high. And do you remember that part of my book where I say you get a double top, so then you buy a higher low? Right? You had a lower low, double top, higher low. No, actually, I didn't put that in the book. I did. It's not in the training course because this, let's say, has as much or maybe even more potential for a move like that than a continuation. Because remember, this is a trend trade. And I think many market participants would say, or more importantly, trade as if it wasn't trending. Blue Boy says you got an ad on how to build your own fund? Really? Who's doing that? It's interesting. I still want to meet with you guys and do a conference where we focus on you launching your own fund and learn how to discuss your track record, learn how to put together slide decks and presentations explaining about your fund and practicing speaking on stage, things like elevator pitches, doing your actual investor presentation, learn how to sort of side angle network, practice, a bunch of different things, analyze other funds and their informational packages. I'd love to do that with you guys, and I know the exact place for us to meet in the United States. It's affordable and fun. We could have some nice steak dinners, have some nice cocktails, have some nice training. Victor's like, Miami. Yeah, but you're always in Miami, Victor. We can branch out a little bit, huh? Orlando. We have to get you guys out of the state once in a while. Hey, we're in Florida. There's no need to leave. Yeah. The only problem with Vegas, I mean, yeah, for sure, RV, and I've been there 100 million times. The only thing is, even though the hotel rooms are affordable, the conferences are expensive. Okay. And so what I would want is something that's both affordable for you guys to book rooms, but where as sort of the conference person doesn't also get jacked on prices. And then you got to then raise the ticket price, so to speak, right? Nothing north of South Carolina. Funny thing is, in some places, South Carolina is north of North Carolina. You can actually drive to North Carolina and then South Carolina by driving north, which is really interesting, right? No. But anyways. What you'd want, guys, is like an airport you can fly in on a cheap airline. A cheap airport to fly into, a hotel that's close to the airport, and then once you get to a hotel, it's pretty kick butt, and yet still cheap, and I know the exact place. Okay. Problem is, how do you get, like, let's say 100 people? Or even 50 people, I guess, could be enough. Not Atlanta. No. The hotels around the airport are horrible. Anyways. Where? It's actually Nashville, Tennessee. Almost, right? Nice in the center of the United States. Cheap to fly into. And I know the place in Nashville. Seattle has nice places, but it's, way out one angle, right? You want something central. So back when I worked in the nonprofit world, we used to do a lot of conferences because you have to motivate the members to work for free. So there's a lot of training that needs to get involved because you have a lot of rotation. Like I think the organization had 100% turnover every, I think it was 3 years, just a little bit less than 3 years. 100%. Thousands of people would come and go, right? Which is natural with a nonprofit. So you constantly had to train, but you had to constantly align people with the mission. So we'd do local conferences, sub-regional conferences, regional conferences, and national conferences. And so there was a regular basis. I've actually been to hundreds of conferences. And so having that central location does two things. It's equidistant for most people, but it's also significantly cheaper than Seattle would be outrageous. New York is outrageous. Even Vegas is outrageous. Although logistically Vegas is quite good, there's also a lot of distractions too, right? But Nashville's kind of cool because you can do outings, but it fulfills all the other things. And so you want to put a bunch of people into a hotel without a bunch of casinos and strippers everywhere. Yeah. Because you lose 30% of the attendees. And trust me, it happens. People don't come to the conference because of the training. They just show up for their personal reasons, right? And I'm like, dude, then what's the point? I'm a very mission-oriented person, so I'm like, what's the point? Okay, so anyways. Okay. But I'm thinking we should just make up an excuse, even if it was just 2 days worth of training. We just need to get together. Okay. All right, cool. So anyways, Kiwi kind of moving, Aussie kind of moving. It's so strange, though, that in most cases it's risk on. Russia's invading, great, risk on. Here's our seek and destroy trade. And we got to be careful because one of the things we've been talking about in our live groups is like giant, massive consolidation. And then pop, okay? Pop, pop, pop. So like, okay, massive range, tight consolidation, break, tight consolidation, massive range again. And gee whiz, right? And this is seek and destroy. So this is the Swedish currency weakening against a dollar. And what I'd rather see here is that the USD weakens based on improving global macroeconomic conditions. And I'd like to see this kind of turnover. So it needs to do this. And then all of a sudden, for the first time in a long time, ha ha ha! Ha ha ha! Okay? And we're not quite there yet. This is still just going to go up forever until it stops. Now, where could it plausibly stop? Well, that's what I have this all about. Okay? That's what that's all about. Okay? You went to Vegas, not Lilyhammer? Norwegians are so well traveled. It's just amazing. You could be backpacking through mountains in New Zealand and you get to the top of the mountain and there's 3 Norwegians. There's always three Norwegians somewhere, right? Hi, backpacking through Laos. Hey! In that case, it's three Norwegians and a Kiwi that they met while backpacking through New Zealand. Yeah, peaceful Vikings, right? They turned raping and pillaging into backpacking, which is great. All right. Yeah. Yeah, I was just thinking about that conference. We'd need probably 50 people. I bet you bare minimum we'd need 50 people at $1,000 a head to get just to even pay for the conference area. Not even to do anything special. So we'd probably need more like 100 people if we were going to do like get the conference area, but then do some cool in cool sort of like I was thinking we need to kind of get used to people speaking in networking settings, right? So now we'd have to like rent an area in the hotel where we can kind of stand around and we're not in a quiet conference room, but we're in a sort of a open area and we've got a cocktail or a drink in your hand and hors d'oeuvres are going around and you get used to like maybe like, old school, right? Pulling out a business card and talking about what you do. And we can practice stuff like that, and then rotate and practice. But then every time you do stuff like that, the hotel's like, well, we can give you the space and we'll provide a little hors d'oeuvres and we'll provide a couple of cocktails. And that's going to be, $4,558 for an hour and a half. Right. And all of a sudden, right. So it'd be interesting to see what that price point would be. But I think that kind of stuff is important. Johnny's been to Norway? Yeah. I haven't been to Norway. My wife has been to Norway. I've been to Sweden, met the royal family of Sweden. Sweden was nice. All right. Just on that conference topic, one of the things we were trying to plan out probably 4 years ago was doing a big, awesome event in South Africa where all of us fly to South Africa and I do training. But my idea of like getting used to doing your pitch, right? Your investor presentation after we've practiced for a few days at the hotel and you got feedback and we made tweaks and you actually build your deck and all that kind of stuff, that we all jump in helicopters and we fly out of Cape Town up into the wine country and we do some presentations and maybe I invite some investors and you actually do a practice round and all that kind of stuff. It would be fun. But then, COVID and a bunch of other things. Okay. That was cool. But that one was more like we have 100 people show up and it's basically $10,000, but you come out with, ready to raise money. So it's truly a professional workshop for those that are already professionals and they're going to go out there and do a raise. That just sounded like fun to me. I'm like, oh my God, yeah, let's get some helicopters. Boop, 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 boop. Okay, so lack of direction here, but this is what we were talking about last night. Okay, right? That you can play this angle. You probably shouldn't expect more than that unless you have a fundamental bias or reasoning for it. Okay, that you recognize a couple of things. Well, actually, one thing. We're at the bottom of a range, and therefore you can range trade it. Okay. So there's all these different things, right? There's your double bottom. There's your roll reversal. There's your 1, 2, 3. There's, right? Now look at this. Yes, Patrick, of course. Yes. Okay. This is what we talked about again last night. Okay. I think were we low enough? 4 hour. Okay. We must have been here then. Okay. Well, what this says technically is this is your target, and you can already see we have a gray zone already identified there. What I also said is I prefer like this type of pattern. So your choice now is to say, okay, definitely kicked off, drag this across, and this would be an example of a day trade. You ready for this? That would be what happens tomorrow. Okay. So you wouldn't log into New York, or I wouldn't log into New York this time of day and say, okay, now I'm going to do something. The reason for it is today's projected high is somewhere in this zone. So maybe we hit this target early, drag this up, and then maybe tomorrow is more like this. Okay. So this would be the trade that you're doing at the end of the New York session. And, you know, basically, let's say not 8 hours from now, but maybe 6 hours from now. Okay. 6 hours from now, I'll probably buy at the same price. And you're like, well, Wayne, why don't you just buy it now? Well, I could. Okay. But I'm buying it high. I thought we were supposed to buy it low. So what's low now? Well, this looks low. Okay, now if it makes an even higher high today, then this will probably be low and not that one. That one would be probably too low. This would adjust and move up. So let's just say kick off that central pivot. So if the next 4 hours takes us up here, maybe tomorrow I buy it around here. Why? Because I only buy low. Okay. And the closer we get to this gray zone, tells us bears only sell high. That, right? So that's when I draw these areas, this means buy zone, this means sell zone. Okay? Sell zone. Okay? This was a buy zone. Okay? 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 Amazingly tight range. Okay? Amazingly tight range this month. Okay? If I zoom in, okay, this is the seasonal move. And the target based on that, again, we're talking about strategy now. Okay? The strategy is this low predicts this high. Basically 80. Okay? 75.50 to 80. That's the strategy. So strategically, if you were a bull, you'd be thinking up, okay, down, up. That would be like standard operating procedure of how you think this is going to go down. Okay, in the same moment, the number one worry for a bull is at this price. You're like, that's where I'm going to be threatened. So you might have, like, let's say, jammed a stop in here and got knocked out on that lower low. Done. Cool. You took some profit. You're in here, out there, at least 100 pips in your pocket for your trouble. Cool. Stabilizes, comes back. Maybe you bought this as a bull. Why? You're still thinking 80. Or you're watching this and it breaches the high, pulls back, and then you take this up for the week. Then it pulls back, and then next week you have a shot at 80. Cool. Cool. Nice. Those are all bullish points of view because I'm not trying to tell you to be a bull. I'm trying to show you how to isolate strategy and tactics with consistency. Okay? Now, the reverse all this, if you were a bear and you started the month here, you'd say, oh, that's just too low. So around here, you want to sell. And you did sell and you did make money and you feel like you're the greatest trader in the world. And now you're very upset. Gotcha. Maybe you're getting knocked out of break even. Ah, man, it worked out really good. And then a whole week later, you're back at break even-ish. Maybe you've jammed your stop. It was here, but then it was here. Now maybe it's here. And you're getting knocked out for either a tiny loss or break even. That's an honorable loss. That's a good loss. In my book, I say take pride in your losses. Because it shows how risk averse you're trying to be. Okay? Now, in high volatility situations, okay, my focus on very small trades or losses, okay, may not be the most optimal. Okay? So like a standard operating procedure for me is a 333, but with lacking trend in many cases, because you get here, that's not 333, and then it drops 80%. Well, that's not cool. And then, right, we're not quite producing this as quickly as we usually do. Right? Even 3 weeks into the month, and we're barely halfway there. And then there's lots of these things where it drops significantly more, let's say more than 33 pips below a daily entry. And you're like, oh, gee whiz. So on the shorter time frame, the volatility is higher, which means instead of getting 382s, you're getting 786s. And that volatility crushes you, right? So there needs to be an update. And so maybe this is a 66, 222, like I was saying, whatever your numbers are. The problem is it'll lower your Sharpe ratio. But, right, ultimately, you're trying to get an absolute return. Understand that. Okay, versus risk adjusted. And the slower trends, if you even want to call that, the slower moves with the higher volatility, right, means that you have to have wider stops and maybe closer targets. So that's why it kills your Sharpe ratio. So your risk-adjusted returns fall, but you still got to make money. Okay. So in these months, you're going for 1 to 2%. And then when the trends come back, when we have a sustained fundamental trend, then at the very least, you can do 66,333 and then adjust this, right? Adjust this as needed. Because remember, if you're taking the same trades, but you're making, let's say 50% more money on, for the same amount of risk, your Sharpe ratio improves. And then if you're able to lower this from 66 to, let's say, negative 44, or 55 instead of 66, then your Sharpe ratio improves even more because you're taking a little bit less risk, but you're also getting a little bit more return. And, that looks great over a fraction, right? So that you're going to be above 1 even more. So your Sharpe ratio might go from 1.5 to 1.7, and that's great. But remember, this typically has to do, of course, you can screw all this up through bad trading, but if you're conservative to begin with, what happens is this is all based on the market. So the beta makes you adjust, right? So what'll happen though is because you're, let's say, doubling your stop, you're probably trading less, but you're staying in the trades more. You're testing the fence less. Okay? And that's probably what is working most optimal. You're always trying to optimize what you're doing. That's probably optimal in these market conditions, but I think that's going to change over the next 5 or 6 weeks. And then we'll once again take a look at the beta by measuring the market and then deciding what the best which one to choose, improve the risk-adjusted returns or continue focusing on simply absolute returns. Okay? Cool stuff, right? Yeah, 30% of the people have left. They don't like these discussions. It's amazing to me. I get giddy over this. So anyways, sorry for geeking out and boring y'all. Imagine, wow. People are interested in scalping, I guess. Okay. All right, scalpers, buy it 20 pips below resistance. Good luck for that. So anyways, I guess it's been a couple hours. I guess that's more than enough. Cool. Well, I don't know if you get that type of information. And I'm telling you, these concerns, like risk-adjusted versus absolute, that's on topic for right now, absolutely for sure. Okay? It's definitely what is being discussed by professionals. How do you adjust to lower expected returns with higher volatility? I want you to think about that. What percentage of professional money managers, whether it's wealth managers or hedge funds or other type of institutional traders, right? What percentage do you think expect lower expected returns for whatever market they're in, like the stock market, for example, but with higher levels of volatility? What percentage do you think are actively having conversations and meetings and discussions and bringing in experts and doing research? What percentage of professionals do you believe are actively right now over the last 6 weeks? Answer it. What percentage? Oh, interesting. I'm glad I asked. I would say actually 100%. This is what's going on. This is what they're like, dude, how do we make money? How do we make money when the stock market's not going to go up 20, 30%? How do we make money when the Fed isn't buying 40% of all bonds being issued? How do we make money when the markets are going to be slow in trend, but then popping up 100 pips, dropping 100 pips, popping 100 pips? Okay? I think they're every single one of them. The strategies from last year are going to be less optimal than this year because last year the stock market was up 30%. This year the stock market's not going to be up 30%. Last year volatility was low. This year volatility is high. We didn't get high volatility last year until we hit Omicron. And then the whole thing collapsed on us, right? Felipe, if you're using an ECN, you have to use the ECN version, right? That's in the toolkit. Okay. Okay. So anyway, I'm glad I asked that. Yeah. But anyways, going back to Felipe. Felipe, you see how I have scan currency indices, ECN? You're probably on an ECN and you need the ECN version. So when I hit this, mine doesn't work because this is not an ECN. Okay. If you do this one, mine works because, again, mine's not an ECN. Oliver's been working developing rules of engagement adaptable to volatility-based bias. So my advice to you to look at, let's just pick a random currency pair here. Okay. So here's a standard setup. I'll get rid of the oscillators because it's not pertinent to our conversation. Okay, one thing that you might want to look at, Oliver, while looking at developing a volatility-based decision process, is one indicator that uses volatility is PSAR, parabolic, stop, and reverse. Okay. And it uses volatility. Okay. And again, if you have to get really kind of nitpicky here, imagine this was your stop loss. So your stop loss right now would be right there. Okay, great. When this is falling fast, you see this? We had a lot of volatility to the downside. And as these candles were like hard red, notice that the stop basically didn't move at all. It said, don't move your stop. Why? It's moving. Okay. Big volatility up and then volatility down. So now we're way down here and the stop has moved from here to here. Then there's some more volatility. It's moving hot and fast. Okay. Notice that we haven't moved much at all now in multiple candles. Okay. We were down. And the stop moved from here to here, which is hardly anything. Okay. And now no lower low, no lower low, no lower low, no lower low. We're losing volatility, right? So actually look at the distance now. It's pulling the stops in faster. The distance from here to here is significantly more than here to here. Why? Why is the gap bigger here? And maybe I have to zoom in now, just kind of make the point a little bit. Okay. The distance from here to here. Look at that. Okay. Relative to the distance from here to here. Okay. Significantly bigger, right? Why? Because we're losing volatility. So what this is doing is as volatility is in your favor, it tells you don't move your stop. Don't you move your stop. It's moving. Man, just let it move. Just let it do its thing. But then when it stops doing its thing, it says, okay, lock in profit, lock in profit, lock in profit. So when you see like this moving almost none, that means it's moving in your favor. Having it go from there to there very quickly means it's not going in your favor, and you got to jam your stop. Okay? Okay? So that's all based on volatility. And it's cool. Okay? And you can monkey with your settings, how sensitive you want it to be. Okay, let's make this 0.1. See what happens. Okay, you can see choppier. Now if we go back and we make it 0.1, okay, more conservative. Okay, so imagine now you shorted somewhere in here, and it says, okay, Wayne, put your stop there. You exit now on this candle when the dots go from above to below, because again, if your stop is here, you're bullish, right? If your stop is here, you're bearish, correct? So if you shorted here with this setting, it's like, dude, you just move your stop to break even, and you want to stay short for the long haul. You see that? It's like, man, you're short here, but don't worry about it, man. This is where your stop is. You're just at break even. So maybe you shorted here. On the lower high, it's dropped all the way down. You've been short for 2 weeks, and it's like, okay, now you can jam your stop at break even. Well, it's not actually jamming stop. It's just that's where, based on recent volatility, where your stop should be. And then, of course, if it makes a lower low, you'll make a lot of pips, but this will barely move. Oops, it'll be here. Because you got a lot of volatility working for you, and it's like, let it run, man. Don't worry about it. Let it run. Just let it run. No, this wouldn't be day trading. This would be position trading. So let's add something here. Indicators, custom. We can do, let's do biased pivots. Okay, I'll go bearish mode because you're a bear right now. And you're going to look at monthly, for example. Okay, so your trade plan for the month of February. Okay, you know that you're either going to sell here or you're going to sell here. And that's, okay, and you're projecting this. You have to understand this is all before, don't look at this to tell you what to do. That's what lamos do. Okay, instead you say on this pair, this is an aggressive entry, this is the ideal entry. Cool. So you take one of those, whatever you want, doesn't matter. Okay. So you get short. Why? Because that's what your trade plan was. Okay. And just so you know, that was a position trade we came up with in the swing and day trading groups. Okay. Cool. We actually came up with that plan. So you get short here. Cool. And what it's saying now is you've earned the right to move your stop to break even or close to it. You've lowered your risk on this trade. And then you should just let it run. Let it run, let it run, let it run. Okay, I think what's interesting is even when the dollar was strong, this trade has been performing well. And I believe, like I said, if we can get through another 5 weeks of down, so let's say something like this. You probably won't get knocked out. Well, I'd like some down, one more down, and then let's say we do something like this. Okay, more like that is what I'm hoping for. If we can get through that, survive, meaning have it not come back and PSR us out, okay? If we can stay in this trade long enough, this trade will actually get better in April and May than it is now. Okay? And that's interesting. Okay, Peter? But it's not day trading. Day trading is you're basically in a trade for a day or less. No, this is a position trading where you're in it for potentially a few months. Minimum 1 month, but potentially several months depending on seasonality. Tell me when I short, when I buy? No, that's not what it does. It tells you how to get out. Felipe, if you run the auto installer, I believe it's in the auto installer, but it's not in the individual files. That's life-changing. Join FX Bootcamp. Okay? This is what we do. So what's RSI? I don't want to cover RSI. It's in the training course. I use stochastics, but stochastics and RSI, different versions of the same thing. Oh, well, it's all in the courses, Peter. ICT. I don't know what ICT is. Okay, once again, we lost a bunch of people on my parabolic stop and reverse discussion. Interesting. Let's go back to commodities. Cool, Felipe. Well, I'll be around tomorrow. Well, that's not bad, Peter. Just make sure you're doing the work, though, too, right? Not that you're not. Just make sure you don't just show up and ask me 27 questions, and I can say, hey, I don't mind, by the way. But I'm just like, make sure I'm complimenting the training videos. So anyways, Brent hit the top. Great, right? Yeah, what is ICT? What do you think about ICT? Bro. And that's funny, too. I notice people are calling me bro more often. I'm like, why? Why am I a bro all of a sudden? I would never call someone my age or someone in a mentor status bro. So it's interesting. Right. Would you call the king of Norway bro? It's interesting. I don't know where it comes from. Like, I don't know. Like, I don't know. I would consider myself either in a mentor role or like a boss role in society. Like, if you work for me, you wouldn't call me bro, would you? If I was your dad, you wouldn't call me bro. Or if I was your dad's friend, you wouldn't call me bro, would you? So I'm not picking on it. I just notice it more often. I'm like, I'm probably older than you and more experienced, and so out of a level, I wouldn't be your brother. I'd be your dad, and you'd call me sir, right, or something like that. Yeah, is it a general? Yeah, it's a general. I'm like, right? I don't think we're brothers, man. Are we? We're not even cousins. I'm your dad's boss. Your dad calls me sir. So anyways, so I don't mean to be arrogant. It's funny. I'm like, bro, I wouldn't call people bro. Now, there are some close friends of mine that I would say to them, man, you're like my brother. Or I might even say, hey, thanks, brother. But even brother is like, I'm showing respect to the title. Like, they're not my brother. We're not even the same race. But I'm like, you're my brother. Your brother from another mother. Cool. I'm showing respect though, right? But bro would be, it's so slangy that I would never call him bro. So maybe it's just me. Yeah, street talk. No, I know. No, I'm not saying you're disrespecting me. It's different. It's just come out of the last few years. Yeah. And it's also, I think, internet, web, you're on 5 chats a day, and then you're on your Discord all day, and all of a sudden everybody's just the same, and everything is just relaxed. I'm not a relaxed person. Okay, I'm an intense person, so. Yeah. 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 Well, I was thinking like in college, people didn't call me bro. I know some people called me sir. So in college, I ran an organization of 3,000 people, right? Just and then later on, just like, I don't know. It's just, I'm not a relaxed person. Very rarely have been bro. So it's just funny. I've been boss my whole life. So. No, I'm just saying, don't worry about it. I'm not knocking you down. I'm just, yeah. Okay, cool. Yeah. See you later, Johnny. Yeah, I guess I'll pull the plug here. It was a good day. Thank you for being here. Thank you for being a subscriber. Thank you for being a client of tradersway.com. Thank you for being a member of fxbootcamp.com. Is that right, Meta? Even you've been going. Bro. It's just funny. I was thinking of all the different, situations where just be on imagine you're being interviewed for a job, and at the end they're like, "Hey, well, I guess that's it for me. Do you have any final questions?" You're like, "Oh, thanks, bro. That was really a good interview. I think this is a great company." And I would stop and like, "Did you just call me bro? Like I'm interviewing you for a job, right?" Anyways, so whatever. Swing trade group, yeah, Thiago, sure. Thursday, you caught the one on Sunday, right, Thiago? I sent out an email to everybody, and then we met on Sunday, and the video is up. It's all there. The yoga fired, right? So, yeah. Lungster King says, ICT will teach you how to get in. So I don't know what you guys are talking about, the ICT stuff. I have no idea. Maybe I'll Google it. What is it? It's just some other group training? Yeah, like, so Lungster, you've been around, FX Bootcamp for a long time. So, but you're saying ICT will tell you how to get in. And this is, I'll teach you why you're in and for how many days, weeks, months. And yeah. So just some other nonsense. Okay, whatever. There's a million ways to trade. So yeah, that's great. So apparently it's good for getting you in, but doesn't tell you why or how long. Okay, well, maybe that's helpful. Add that to the technique, okay? So, anyways, Inner Circle Trader? What the hell is that? Sounds like a get rich quick thing. Inner Circle. It's so funny. The Inner Circle Trader. Well, I guess I'm an Illuminati, so I got into that inner circle. So anyways, so peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day. I'll see you later. Cheers.